Hello, everyone. You're not getting in too late. Yeah, it'd been better to get long silver at 20 bucks or 30 or whatever, but this is the entry point, probably the last one you're going to get. Okay. Yeah, and I think we will, and I think other factors will come into play. Other asset categories will help assist in the shift, like we just saw in the stock market spreads versus gold. Something happened there. There's already money moving. Every day they talk about, oh, new high in the S&P. Well, it's like, nudging like a snail on a chart. And where's gold surging? And only recently have the financial news networks even talked about gold. And usually when they talk about it, they say, oh, it's excessive. Instead of cheering the new high, oh no, it's excessive, meaning don't buy it. Okay, fine. I like that. I want people to stay out as long as they can because when they come in, you get the rush. But as gold goes up, and it won't be as dramatic as silver, no percent wise, silver is the one that has the dues to pay on the upside. I mean, in a new reality to go to after being suppressed for half a century. And I have minimum target, I my own personal positions, which I reveal at the end of each of our reports, is that we'll probably see 200 bucks by the second quarter. Now, I could be wrong. We might vastly overshoot and see something even higher than that. Uh, Seriously. So I'm open to that possibility. So I do not have a precise target. I have a ballpark target, and I think the minimum end to that is about 200. Now, there will be a jiggle in the middle. In fact, in the 79 to 80 surge in the 2010 to 11 phase, there was a jiggle in the middle where about 3 months into the move, you had what looked like a reversal month and looked like, oh my gosh, that's it. And it wasn't. It was a fake out. And then you tacked on another 3 months. So I'm fully expecting that in the next 6 months, while we go up massively, there will be a point probably somewhere in the middle of that. And it'll be interesting where that occurs, because if that occurs well over 100, then it's telling me, yeah, the 200 is likely. Now, if that occurs only at 82 and 2 to 3 months from now, we only crawled another 10 or 15 bucks, then maybe we'll have a less subdued high. But my suspicion is by the end of the next couple months, remember, this is month one now in the breakout. You broke out November. So December is the first month. So I'm counting 2 quarters from there. Anyway, I think that likely we'll see at least. And I think silver, if you go back in history, silver ratio to gold, or not the ratio, but the percent scale in 1979, silver reached 6.5% of the price of gold at the top monthly close. And the peak monthly close back then, we touched 50, but the close was like 38 or 39. So at that peak monthly close, silver was 6.5% the price of gold. Okay, in 2011, it was 3.5% the price of gold. Okay, right now we're trading around 1.5% the price of gold. Meaning if you go to even 3.5%, match the 2011 relative performance level, that's more than a doubling of silver relative to gold from where we are right now. And the other assumption I've got is if the price chart has been caught in a range for 50 years, why should we assume that the spread relationship between silver and gold has to stay below the highs it saw in the last 50 years, 6%, 3.5%? What if we take out both of those as well? Woohoo! You do the math. Entry points that we've given over the years are far below current levels. Okay, the last major entry point we offered on silver was as it approached $35 from the underside in June. Okay, it's since almost doubled. Okay, that was a momentum based signal. And of course, silver blew a cork after that. Shout out to the, well, still blowing the cork. Okay. But from the point of view of this chart here, taking out the price range, but also the spread relationship to gold breaking out as of November, also the monetary metals. Silver also broke out versus the S&P, by the way. So all those metrics are saying, hey, something just began. Answer to your question. If you're not into monetary metals, yeah, it looks late on the chart, but actually there's signals that are being rendered here that are saying, no, the big game's really just beginning. So if you get in now, you're not getting in too late. Yeah, it'd been better to get long silver at 20 bucks or 30 or whatever, but this is an entry point, probably the last one you're going to get. Okay, this is the XAO index, which goes back to the 1980s. GDX is the popular ETF gold miners right now, but it only goes back to 2006. XAO goes all the way back to the 1980s. It's a gold and silver miners ETF, Philadelphia Exchange. It lived in this is dividing XAO price into an ounce of gold. And you can see from the 1980s, 90s into 2008, it lived in that red range, meaning the lowest it got versus gold was about 17.5% of the price of an ounce of gold. The highest it got was like 35%. And it lived in this range for multiple decades. And then in September of 2008, actually 1 month before they really collapsed the mining sector, you broke below the bottom of that spread ratio, spread box there. So you blew out the bottom. That was a sell signal in effect, saying no longer are the gold miners going to be on par performance to gold. They're going to underperform. And boy, did they, because the spread relationship dropped from like 7 way down to 4% by 2015. Now, what are you going to do? Go to zero? Okay. No, of course not. But the miners have been vastly undervalued for 11 years now. That green rectangle, that range is like just above 8%, like 8.5% was the highest reading in that range. And the low was 4% back in 2015. We're now surging up toward the top. That range on the spread, if the miners can break out over the top of that green rectangle, meaning divide XAU into gold and find that on a given monthly close, XAU is more than 8.5% of the price of gold, expected to surge massively. Now, even if you just go up to resistance and you can see where resistance is, it's the old lows up at that 1.5% level. Well, heck, that's a doubling. You get a breakout above 8.5, that's doubling to get to 17. So that means the miners could double in relative value to gold just getting up to that red line. So what this spread chart is telling us is that not only is gold shifting versus the stock market and silver and the miners are breaking out versus the stock market, but relative to gold itself, the miners we know they're cheap. Everybody talks about how cheap they are relative to their intrinsic value. They're waking up, and if they go through the top of that range, expect a gusher on the upside in terms of net price for the miners and true relative gain versus gold. Likely to be at least double. Now, I'm not going to predict how long that takes, but I would guess a year or so. That it means even double in relation to gold. But gold's going to be going up while they go up too. It's just like when it broke down in 2008 through 15 especially through 2011, 12, and 13, 4, 15. The last 4 years of that decline was also going down. So not only were they collapsing in price, but they were collapsing in relative value. So it was even worse for the miners. This is the opposite situation now. So a lot of people now who are fearful that the gold miners will go down with the stock market, we're in a totally opposite position that we were into. Red circle and that black arrow in the middle of the chart. You broke down prior to that October crash in the stock market. Also a month where the miners broke down, and after that, the miners languished relative to gold. Yeah, they made a new high in 2011 in price, but it was nominal where gold doubled during that time. But now they're in an opposite technical position. This is the gold mining sector, GXU Gold and Silver Miners Index going back to 2013 again when gold was collapsing. So were the miners relative to the S&P? They were losing value to the S&P. So the spread was collapsing. They made a low near 2% back in That's actually when XAU index made its lowest price. And then you had a couple surges in performance in the gold miners relative to the S&P. Those also were surges in XAU price as well. Again, you have a line like you have on the gold chart, where for 11 years, you have this very precise line that you hit 1, 2, 3, 4 times in this case. You blew through it in November. In other words, the gold miners are now saying, hey, I'm not going to be weaker than the S&P. I'm going to be stronger, which also tells us that probably there's already money beginning to leave the stock market, even though it's not going down. It's certainly not much going up either for 3 months. It's going somewhere else. And we know the gold miners have been exploding, and given the tininess of that sector, it doesn't take a lot of money moving from a decaying asset category like the stock market and moving into the miners to take these guys off the page. So this is another argument that miners are a place to be and don't be haunted by that event in 2008. The conditions now are opposite. The technical conditions in 2008 relative to miners think, yes, it is. Yes, you're chasing when you look at a chart going back a couple years. GDX, for example, the popular gold, and it's got some silver miners in it. ETF took out the 2011 high just recently, and it's living on top of it. It's quite firm, but it just broke out over those highs. Well, this spread same is true with GDX. By the way, if we could plot GDX versus S&P, you get the same picture you see here. So it's a fresh asset class signal shift saying buy miners, sell S&P, or if you prefer one or the other, just go to the miners, leave the S&P alone. I suspect the spread's going to explode, just like the XIU versus gold spread is likely to explode, meaning full fuel in the tanks for the gold miners. They're a vastly undervalued stock market category. A long-term investment point of view, not the dynamite move that we think we're about to see in gold and silver, especially silver in the miners. The broad commodity complex collapsed from that first major surge high, which MSA did call about 70. We said Bloomberg's going to explode. It went to 140 within a year and a half, so it doubled, still very cheap.